Welcome to the Morningstar series, Why Should I Invest With You? I'm Holly Black. With me in the studio is Rob Burdett. He's manager of the BMO Multi-Manager Navigator Distribution Fund. Did I get that right?
You did.
Welcome to the studio.
Thank you.
So what does that mouthful of a fund do?
So it's a multi-manager distribution fund. So it's aiming to pay out a reliable, regular income. In fact, in our case, in the top decile of the sector for yield. So that's the target.
And a multi-manager fund picks other funds to invest in. So how many are in the portfolio?
Usually it's between 30 and 35 underlying funds. But importantly, there's lots of areas we're leaving out. So that might sound like a lot of funds, but they're individually very carefully chosen. So there's no passengers, no padding. Everything has to count.
And is there a particular type of fund that you're attracted to?
So we've got two tests we're looking for. One is that the yield of each underlying fund is natural income. Nobody wants their capital given back to them as income, not least it's tax inefficient, but you're eroding the capital base. So that's the first test. The second test is, and it's a little bit more subjective and our opinion, is that on a 5-year view, the capital should have a good chance of at least being intact, ideally in real terms after inflation, to keep that capital base there for future income growth.
And is there anything that you avoid that's a red flag when you come across a fund?
I guess if the income was a bit iffy, that it wasn't natural yield, so that's sort of a negative filter for us. I guess we're looking to understand how the yield might progress. So in equities, companies grow their dividends over time typically, so that's fairly straightforward. But in some other areas, we've seen a rush to income products that's driven the risk return to unacceptable levels, we think. So we're trying to avoid that.
So income's been harder to find in recent years. So how are you finding it? Are you mostly in sort of equity funds that are getting income from dividends, or is it bonds?
So the portfolio today is a little over half invested in equity income funds, and we're expecting the dividends there to grow this year by at least 5%. And next year the guidance is broadly similar. So you're getting growth on half the portfolio, and the yields are really attractive. So the all share at the moment is yielding around about 4%, which is, compared to interest rates and bonds, is a post-war high. So that's quite attractive in its own right without the growth. The other half of the portfolio is invested in bond funds, but very carefully selected. We can maybe come on to that. We're avoiding government bonds, investment grade corporate bonds. We don't have any dedicated high yields. We're looking for other things that are going to be unaffected by the direction of rates and where we might have a bit more security for the yields we're getting. So that might be floating rate or asset backed.
So what are some of the themes in the portfolio that you're most excited about at the moment?
So right now, equities, I think, offer a good risk reward. There are some challenges ahead. We're expecting global growth to slow down, but you're being paid quite well for that risk. In UK, we've talked about, we're overweight the UK, and that's quite unusual, we seem, amongst our peers. We like small cap. Small cap is quite cheap on a historic basis. It may be volatile, but I think the argument there is you get the growth that quality growth funds, which are all the rage at the moment, offer, but without the ratings that those kind of funds appear to be on.
Super. Well, thank you so much for your time.
It's okay. Thanks for asking.
And thanks for joining us.